All right, so welcome back to Multifamily Live. Super excited for today's guest, Ken Gee. Hey, Ken, how you doing?
Doing great. About yourself?
I'm doing great. I'm excited to dive in here. Ken is the founder and managing partners of KRI Partners and the KRI group of companies. He has more than 24 years of significant real estate banking, private equity transaction, and principal investing experience. Throughout his career, he's been involved in transactions valued at more than $2 billion, much of which has included the acquisition management and financing of various multifamily real estate projects. So, Ken, ton to dive in here. So 2 billion of transactions over 24 years. I mean, you have not staying the sideline long, right? So you've been active. What was it that out of the gate, of course, really got you into the direction of multifamily investing, and specifically just to form the company and really dive into so many transactions over the last 24 years?
Yeah, so good question. So initially, I started out. I got my undergrad from the University of Toledo, and this is all gonna make sense in a second. Got my undergrad in finance, went to work for a bank in Cleveland. When I was at the bank, all my customers talked about owning real estate, making a lot of money in real estate. And I got my master's in accountancy, went to work for Deloitte for 7 years. All of my clients at Deloitte talked about making so much money in real estate. You know, they were absolutely just killing it. And I finally said to myself, as I was working 80, 90 hours a week as a CPA, what am I doing? I need to do something different here. So I went out, bought my first apartment complex in a small area of Cleveland called Shaker Square, 28 unit building. I was still working for Deloitte at the time. And then we just, slowly started buying individual deals. Then decided that this thing should be more than just buying an apartment building and selling it and buying another one and selling it. So we went into third party management. And now, fast forward to today, our senior management team's got about 15,000 units of experience under their belt. And, we've done a number of transactions, not only real estate transactions, but, all our client, we have been involved in our clients' transactions, as well as a ton of private equity work when I was at Deloitte. So that's kind of how I got into this business. And it's been a ton of fun.
Yeah, I can imagine there. And so going into the position today, right, with the vertically integrated approach here, is it just your assets that you manage, or are you also now, did you mention you're mentioning for other companies as well? And was that the initial approach from the beginning, or did you, quote, start in-house to manage your own properties and then found that you had the scale and you could also accommodate others as well?
Yeah, believe it or not, we first got into third-party management when we were in Cleveland. And it was because of the run-up in values in 08, 09, lots of outside folks started to invest in Cleveland. There was no real third-party industry, no group of people doing it in Cleveland, because Cleveland had historically been an owner-operator town. And finally, people just kept asking me to manage their properties for them. And I finally said, okay, we'll do it. So, a lot of things in life happen, not necessarily purposeful, but it made sense, right? These assets were being managed by companies that didn't really know how to manage anything but single family homes. So it's very different to manage apartment complexes. And those properties were located right next to properties we owned. So it was hurting us in a big way. And I said, you know what, I really have to dive into this. So then about 10 or 15 years ago, Cleveland is not a growth market, that's for sure, but Central and Northern Florida are growth markets. And so about 10 or 15 years ago, I said, you know what, if we can do this well in Cleveland, imagine if we had massive tailwinds, like huge demand, huge population growth, and just, low tax states. So we went down to Florida, and now we bought several assets in Florida. Then we decided it was okay. We understood the market well enough to offer our services to to do third party management there. So we currently manage about 2,000 units throughout the state, and we're continuing to grow. Some of those we own, and some of them we manage for others.
It's really interesting. I always say that you have to be careful around all the ownerships around you, because you could be the best owner on the block, but the rest of the owners are horrible, right? They're going to bring you down. But you threw in the piece that I hadn't thought about. But if you go out there and take over managing their assets, doesn't matter who the owner is, you can help turn them around and help yourself in the same point. So it's really
exactly
interesting.
Why we did it.
Yep. It took that approach. How are you looking now where we are today, right? We've seen so much happen with, cap rate compression, so much happen with just even where the treasury yield stands today, how much happened with just how much money's in circulation out there and just where pricing is currently. How are you preparing yourself currently today, or even for the next, 3, 5, 7 years, just on the landscape of just what you're looking at in terms of deals, right? Because we see pricing has just gotten very aggressive. And I'd be curious because, 24 years, you're talking 08, 09.
Yeah, we saw that
today compared to where we're seeing some of these past trends that have happened.
Yeah. So what's really important, if I compare and contrast 08, 09 to what's happening now, it is very, very different. Number one, we don't have a lot of individuals buying homes and just literally lying on their mortgage applications. That's not going on. We don't have lenders who are making completely ridiculous lending decisions and underwriting decisions. They're holding the line. So they don't mind. You can pay whatever you want for an asset, but they're going to hold the line. They're going to make sure you have a 110, 120 debt service coverage. That's important to them. Before, they weren't doing that. They were letting you go below 1. And just assuming that the appreciation would eventually get you out of the deal, which was a terrible decision on their part. But they wanted to get these deals. So the way I see this happening longer term, we're always very particular about what deals we do, and we just really stress test them to make sure that we know. We always buy with there's upside, right? That's just what we do. And with the markets that we're in, rents are growing like crazy. And we still find a lot of people who have not kept up with the market. And when they haven't kept up with the market, they're several $100s behind the market. So we're seeing that a lot. So if we can make a deal work at today's rents, right? And I always say we protect that downside and move cap rate some and see what happens. If we do that, then that upside is going to take care of itself. Yeah, so that's kind of how we're underwriting right now.
What is a typical deal criteria look for you? If you had your avatar deal that you go after, what does that typically look like?
Yeah, plus or minus 100 units. For the fund that we're currently deploying right now, we just wrapped up a raise on our first fund. So we're deploying around 100 units, BC class, multifamily only. And we're looking for value add. And it's mostly through rent upside, either from physical improvements or management improvements. And believe it or not, we're finding usually it's more physical than management. Right now, it's more management than physical improvements that are necessary to get the rents up. So that's what we typically look for. And we're trying to hold for 3 to 5 years. That's what we pro forma out. And, it's our goal. We try to underwrite to a minimum of 15% annual return. So that's our deal. That's our avatar deal.
And is that a deal level or for investor return that you look for?
It's investor return.
Investor, that's great.
Yeah, that's what matters, right?
Of course. And when you think about here, you said something interesting. Now you're finding out it's a lot more management compared to before. It was a lot more on the CapEx side. Would you find that it just you find a lot of property management companies are more geared to construction, but miss the where you're getting the value and that you're able to manage it so efficiently, right? That you're capturing on not only just maybe potentially the rent growth, but you're finding the other income that could be added in. You're finding all the expenses, or is there something else driving this narrative right now?
Yeah, it's mostly the increased demand for our product. I for some reason, a lot of owners are happy to just keep their properties full. And if they're full, they're cash flowing, they're happy in their mind. If it ain't broke, don't fix it. That's what I think they're doing. And we see a lot of properties that should be passing through utilities and they're not, and all their neighbors are. We see a lot of properties several $100s below what they should be charging, but they're full, right? And so a lot of people, they got beat up in 08, 09. They like being full, and they like knowing that as fast as they turn that unit, they're getting another renter in there. And so that's what I think is going on. The market's moving pretty fast, and in the growth markets that we're in, it's with good reason. I mean, there are people moving to those areas like crazy. And when you think about the BC class, this is why we love BC class assets. They are not building BC assets.
Yeah.
Right. They're building a lot of A stuff. And who moves into A stuff? Pretty wealthy people. Well, if you think about Florida, about 1,000 people move into the state every day. That's pre-pandemic numbers. I'm sure it's higher now. I just know it is because we feel it. Right. Those 1,000 people, they're not all rich. they can't all afford 4,000 or 5,000 a month in rent. A lot of those people are just normal, ordinary people. They need a place to live. So we have that increasing demand. We have no new supply. Think about your econ class. Prices got to go up. It just has to, because everybody's fighting for a finite supply of product.
So you, in a cycle like this, where you see Florida, you have this mixed thing, right? Where you have, just like you said, you have a ton of people, like you had 1,000 pre-pandemic. It's more now. We just don't know what the number is, but it's definitely more now, right? You have a supply constraint where there's just not enough housing coming on, especially in most areas, Florida itself. And that's a big push, right? So you look at it and you look at a runway here is that, okay, so a market cycle comes up. Is it going to be as bad? Well, the B and C, as long as you keep yourself where, household income can be approachable, right? And people can be there, is that where can the downturn go? Because they have to live somewhere, right? And we're at a point here where even in the A's, that's where you start seeing some of your concessions happen, that start trending down and push those people into the B's. So it's a well-insulated area, especially as long as you can stay in markets like a Florida that can keep you with all the other drivers pushing forward. Am I too far off base, or would you?
No, you're dead on. That's exactly right. When I talk to people about, because I have this conversation a lot, aren't you afraid you're at the top? Aren't you afraid? Well, pricing is a function of demand and supply. It's that simple. One of those two has to break down.
Yeah.
You'd have to give me a reason for people to stop wanting to live in Florida. I mean, this has been going on for decades. It just happens to be a little accelerated right now. All right. So maybe a slowdown. It's the growth rate isn't quite as fast. It's still going to grow. All right. It might fall to 900 people a day, but most jurisdictions would kill for that kind of growth. Right. Or supply would have to explode. And you can't build BC class assets affordably. You just can't do it. So one of those two things has to implode in order for me to get stressed out about Florida. That's why 10 or 15 years ago we went there, because it just makes sense.
Do you find, in terms of your ability to transact, how has being vertically integrated helped you stand apart from other companies that maybe would be, par for far on the acquisition side, but how has that given you the advantage to find deals?
Yeah, two huge advantages for us. Number one is that vertical integration. And that's because we think about this, right? You're working alongside a colleague, and that colleague would be a broker, right? You buy, sell through that broker, and they get to know you as a customer. And now, because you're vertically integrated, because you manage properties as well, they send you their clients to manage the properties that they sell to them. Now you're kind of standing next to that broker, helping them develop their business. Right. And we make commitments to them that we're not going to, we're not going to do anything to screw up their deal, or we're not going to do anything to make sure that guy goes to somebody else when he sells. Right. We don't destroy that relationship. So when you're standing next to someone, your relationship completely changes. So then when a deal comes that they want to quietly market, or the seller wants to quietly market because they don't want the whole parade of people, guess who's top of mind?
Yeah,
we are. Now, the second advantage that we have is, remember I said we have a fund. Most people that buy go find the deal, they syndicate, and then go raise the money. Well, when they in that situation, they have to convince that seller to go under contract with them, knowing that it's possible that they won't raise the equity, right? Because everybody says they always raise money, right? That no one will tell a seller, well, I might not raise the money. That's not what they do. Exactly. But some do fail. Flip that around, put the money in front of the deal, which is what a fund is. We've raised the money. The fund is raised. We don't have that risk. That risk is off the table now for us. So when we talk to sellers as a buyer, we're a far stronger buyer, especially when you're looking at the smaller market that we're in, right? Most fund managers are going for 300, 400, 500 units, right? We're down in the 100 unit level. No fund managers are competing with us. We're competing with the syndicators. So we just have a distinct advantage. A, we have the network relationship with the brokers, and B, we've got the money raised already.
That's great. And how has being so hyper focused on Florida, right? Because you see two approaches, right? So one is that you get hyper focused on the market, right? So you're well ingrained, but you're limited on of course, how many transactions can occur, which you're in a good spot. But then on the other side, you see the shotgun approach, right? Where you're kind of anywhere and everywhere, gives you more opportunities to deals, but you don't know what side of the tracks you're on. So how has it allowed you to be, in Florida? How has that allowed you to really just continue to scale to $2 billion in assets?
Yeah. So what you just said is critical for us. And that is, it's not a shotgun approach. We're in all these markets. We're operating there every day. I mean, I'm looking at a deal right now that we just know it's under market. The rents there's a ton of upside in the rents. Why? Because we've got 3 or 4 assets nearby. We understand the market. We understand why it's a good market. We understand the risks of each market. So the deal flow, there's fewer deals than if you were looking in all 50 states. But I think it's so important, especially when you're investing with someone else's money, as well as our own, all right? But it's really important that you really understand that market and tick every box you can to minimize the opportunity for a loss there, right? I mean, you want to do well for investors, and no better way than to start with really, really understanding the market.
Yeah, absolutely agree. How does your team look? And so maybe not the fun side, but how does your internal team look in terms of, what duties do you carry forward, and what are some of the other pieces that you put into the mix?
So when you say my team, so our team,
like KRI partners, right? So at this point you have, I would treat it like, and please correct me if I'm wrong, right? You have the acquisition arm, and then you have the management arm, right? And then in between you have the asset management arm, or whatever pieces. Where do you enjoy being in terms of
there's no question on the investment side.
Yeah.
I mean, property management is a tough business, especially when you're doing it for others, right?
Correct. Yeah.
It just is. It's a tough business. It fits with what we do. That's why we do it. We're not going to stop doing it, but clearly the more fun part is the investment side. I mean, we've got probably 50-ish employees that are running around doing property management activities, as well as on our own properties.
Yeah.
But, it takes that number of people. We've got 5 or 6 on the investment side. You don't need that many people. And whenever you can find a way to have a business with fewer people, especially in this labor market, it's far more fun.
Yeah, that's actually a good point right there. The labor market's insane. And I find here that I have that talk a lot about, being market specific, right? Because of what you just said here, and just really compared to being everywhere. And right. And typically, I find out more on when someone's first getting into this, is that they want to be everywhere, because it's that fear of missing out in that point here. But you're missing out on everything, right? Because you don't know a good deal from a bad deal. So you have 5,000 deals in front of you, of which you can only look at 7 of them. And by the time you get your time is so valuable. But in that same front, for the 7 you look at, you could have 2 deals in Memphis, one's $7,000 and one's $150,000 a unit. And the $7,000 unit is a horrible deal, right? Because you're in the wrong side of town. The $150,000 is a stellar deal. But on the concept, you're, over in Idaho, and you think, oh, 7,000 must be a good deal. Right. And so you can't get off the ground, or you do a bad deal to get out of the gate. So it's really well positioned. And it's really good to hear it reinforced, is that longevity comes with systemizing and finding the approach and just being honed in, right? Because it's not like Florida's been a new entry point for you. We're talking, 10, 15 years, you said that you've been into this market here. Yep. The 100-unit approach, and with the fund, when you do each fund, is it typically just a new revamp of capital, or is it still, you may target differently on the type of property you're going after each time you go in there? Yeah,
our next fund, we may split our funds serve our investors, right? So some investors, first of all of them believe in real estate, right? Because they can see how much money you can make. Some of them like to turn that money. They like to see the asset go full cycle, right? Because it's hard to argue. You bought it, you did what you did, you sold it, you made a lot of money. I mean, there's no way to argue with that, right? It is what it is. It's done. I made a killing. I feel great about it. Others know that the more tax efficient way to do this is to buy and hold longer term and refinance, get your money out, or get as much of it as you can out. And your returns really explode then, because your equity in the deal is so slow. So low. So what we may, we're seriously contemplating sort of a bifurcated approach, because we have investors that want to do both. And, you don't want to cram a long-term investor into a short-term fund, or vice versa. People want to be where they want to be. And believe it or not, a lot of people want to have some in this type of deal and some in this type of deal, because they just know they need to be in real estate. And why not? Because when you have those longer term deals, they tend to be higher quality assets. They tend to just be more about cash flow and long-term appreciation. So that's what we will likely do next fund. We're just trying to figure out what's going to actually make sense.
Yeah, as well said. You find that most investors, when they have the short-term outlook here, it's just that they like to see it turned over. But once you turn it over once or twice, they say, "Can you stop giving me my money back? What else do you have?" Right? And then you say, "Okay, this long-term approach is much better, because every time you give me my money back, I got to find someone like you again to go give money to. And then if I don't, then I'm sitting on this money doing nothing. I should have just kept it with you, right?" So I can see where that narrative definitely comes in. I mean, Ken, this is great, man. Thank you so much for your time. Really appreciated your narrative on what you're doing, because it really reinforces a lot we talk about. So really appreciate you. For anyone listening that wants to hear more about your company, what's the best way to hear more about you, the company, connect more with your firm?
Yeah, so probably the best thing I would encourage people to do, go to our website, kripartners.com/ebook, right? It's an ebook that I wrote. It's not very long. It's called Multifamily Real Estate's a Total Game Changer, because I believe it is. You too can build massive wealth as a passive investor. Now, here's the point of the book. It addresses two questions. The first is, just like many of your listeners, they know there's a ton of money to be made. They're just trying to figure out, how do they fit into this puzzle? How should they buy a double? Should they buy a single? Should they try to go out and buy an apartment complex? Should they invest in someone else? What should they do? So I help take them through that process, and even what kind of asset to buy, apartment, a medical facility, what should they buy? Then the second part, assuming they should be passive, because most people generally should be passive because they have really good full-time day jobs that they don't want to quit. How do you vet the sponsor then, right? Because that's the other critical thing that people need to focus on, because you want to make sure that you have a good sponsor that you're working with, or a fund manager, because they're the ones that are going to hopefully make you money on the passive side. And the second half of the book talks about some of the inner workings of our business and what makes fund sponsors tick. Why do they do what they do? How do you spot somebody that's in it for the short term versus the long run? So again, kripartners.com/ebook. It's free. It's a download. And I offer to only because I know that a lot of people are facing this question, and I just talked about it so many times. I thought, you know what? I need to write something up here, because
that's fantastic. I actually, one quick narrative is that people say, well, how do you know if someone's in it for the long run? I say, go to their Facebook profile and see if they've had 96 different job titles in the last 7 years of, everywhere from boat salesman to power washer to crypto investor to that. Probably doesn't mean they're in for the long run. And if they have that, I'd probably ask them, is a 7 or 5 year investment, something that they really think they could sustain. Right. But that's well said. Thank you so much. We'll have that link here in our show notes, and for everyone listening. Thank you so much, Ken. Thank you so much for being on the show. Super appreciate your time.
Great.
And we'll talk to you shortly.
Thank you.